Hello and welcome to Finance Talks Podcast. I'm Ryan, and I'm here with Priya, as always, to bring you clear, practical advice on all things finance. Today, we're tackling a question that so many of you have been asking: how can I start investing in stocks with just $100? Now, I know $100 might not sound like much, especially when we hear stories about big-time investors with thousands or even millions in the market. But here's the truth. Every investor starts somewhere. And starting with a small amount like $100 can actually be a smart way to dip your toes into the world of investing. In today's episode, we'll be showing you exactly how you can begin, even with a limited budget. We'll talk about how to set up your first investing account, what kinds of stocks or funds make sense for small investments, and, just as important, how to avoid the mistakes that many beginners make when they're starting out. Stick with us, because by the end of this episode, you'll know exactly what steps to take to grow that $100 into something much bigger.
Thanks, Ryan. Hi, everyone. I'm Priya. And let me just say, this is such an exciting topic for us to cover. Investing doesn't have to be overwhelming, even if you're starting with just a small amount. In fact, this is one of the best ways to learn and build good habits without taking on too much risk. Today, we'll focus on breaking everything down into simple, actionable steps. You don't need a finance degree or a massive budget to start building wealth. What you do need is the right mindset, a bit of patience, and a plan. We'll also touch on the tools and platforms that make investing with $100 incredibly easy, even if you're just getting started. Plus, we'll share some practical strategies, like using fractional shares or ETFs to maximize your investment, and explain why things like diversification and consistent investing are so important. So, whether you're completely new to investing or looking for a smart way to get started, you're in the right place. Let's dive in and turn that $100 into the first step of your financial journey.
All right, let's start with something that surprises a lot of people. $100 is more than enough to start investing in the stock market. Think about it. Years ago, investing required hundreds or even thousands of dollars just to buy a single share of a big company like Apple or Amazon. But today, thanks to fractional shares and low-cost platforms, you can start with as little as a single dollar. The key here isn't the amount, it's the habit. Starting with $100 gives you the chance to learn how the stock market works without putting too much on the line. It's like training wheels for your financial journey. You're not just investing money, you're building the skills and discipline you'll need when you're ready to invest larger amounts. Now here's the exciting part. Even small investments can grow significantly over time because of something called compounding. For example, if you invested $100 today and it grew at an average rate of 7% per year, which is typical for the stock market, it would double to $200 in about 10 years. And if you kept adding to it, say $100 every month, the growth would be even more dramatic. So don't underestimate the power of starting small.
Absolutely, Ryan. Starting with $100 is about more than just numbers. It's about taking that first step toward financial independence. Many people hold back because they think they need thousands of dollars to get started, but that's simply not true anymore. Let me share a quick example. Say you want to invest in a company like Tesla, but its stock price is over $1,000. With fractional shares, you don't need to buy an entire share. You can invest $50 or even $25 and own a small portion of that stock. This makes investing accessible to almost everyone, regardless of how much money you have. And let's not forget ETFs, exchange-traded funds. With $100, you can buy into a fund that tracks the entire stock market or the top 500 companies in the US, like an S&P 500 ETF. This way, your $100 is spread across hundreds of companies, giving you instant diversification. It's a smart, low-risk way to start building your portfolio. The key takeaway? Don't wait until you feel like you have enough money. Start small, start now, and let time and consistency work their magic. $100 might seem small today, but it's the seed for something much bigger in the future.
Now that we've talked about why $100 is enough to start investing, Let's dive into the practical steps to get started. The first thing you'll need is a brokerage account. This is essentially the platform that allows you to buy and sell stocks, ETFs, or other investments. For beginners, the good news is that there are plenty of brokerage options that make the process incredibly easy and accessible. If you're in the US, platforms like Robinhood, Fidelity, or Webull are excellent choices. They offer zero commission trading and support fractional shares, which means you can invest as little as $1 in a single stock. If you're in the UK, platforms like Freetrade or Hargreaves Lansdown are popular. For those in Canada, Wealthsimple is a fantastic option with a user-friendly app. Most of these platforms are designed for first-time investors, so don't worry if you're not a tech expert. It's really as simple as downloading an app and signing up. Once you've chosen a brokerage, you'll need to go through a quick setup process. This includes verifying your identity with basic details like your name, address, and sometimes a government-issued ID. After that, you'll link your bank account to the platform so you can deposit your $100 and start investing. And don't worry, these platforms are regulated, so your money is safe.
Great points, Ryan. Let me add to that by talking about what happens next. After you've set up your account and deposited your $100, it's important to familiarize yourself with the platform. Spend a few minutes exploring the app or website. Look for key features like the search bar to find stocks or ETFs, the portfolio section to track your investments, and tools that allow you to set up recurring investments. These are fantastic for building a habit of investing regularly. Now, here's a tip for beginners. Make use of the educational resources that most brokerages provide. Many platforms offer free tutorials, articles, and even simulators where you can practice trading without using real money. This is a great way to build your confidence before you invest your first $100. One more thing to keep in mind: fees. While most modern brokerages offer commission-free trading, some might charge fees for certain transactions or services. Be sure to read the fine print to avoid any surprises. And if you're unsure about anything, don't hesitate to reach out to their customer support. Setting up your investing account is your first major step, and once it's done, you're ready to start building your portfolio. It's simple, straightforward, and takes less time than you'd think. By the end of this process, you'll not only have an account, but also the confidence to take your first step into the stock market.
Exactly, Priya. To recap, setting up your brokerage account is like opening the door to the world of investing. Choose a platform that suits your needs. Complete the verification steps, fund your account, and take some time to learn the basics. Trust me, once you've done this, the rest will feel much less intimidating. And remember, the goal isn't just to set up an account, it's to get comfortable with the tools and understand how to make smart, informed decisions. When we come back, we'll talk about what you can actually do with your $100 once it's in your account. Stick with us. We're just getting started. All right, now that your investing account is set up and ready to go, let's talk about the most important part: how to invest your $100. With limited funds, you'll want to make smart choices that give you the best bang for your buck while minimizing risk. The first option I recommend is fractional shares. Let's say you want to invest in a company like Tesla, Apple, or Amazon, but their stock prices are hundreds or even thousands of dollars per share. With fractional shares, you can buy a small portion of a share, say $10 or $20 worth. This means you don't have to save up for months just to own a piece of a big company. For example, imagine putting $50 of your $100 into a high-performing company like Apple. Even with a small investment, you'll benefit from the company's growth over time. Plus, owning shares in reputable companies can give you a sense of confidence as you learn the ropes of investing.
Great suggestion, Ryan. Fractional shares are such a game changer for beginner investors. Another fantastic option is ETFs, or exchange-traded funds. These are essentially baskets of stocks that track a specific index, like the S&P 500. When you invest in an ETF, you're not just buying one stock. You're getting exposure to hundreds of companies at once. This is perfect for beginners because it spreads your risk. Let's say you put $50 into an S&P 500 ETF. like SPY or VOO. Your $50 is automatically diversified across top companies like Microsoft, Google, and Coca-Cola. Even if one company's stock dips, the overall value of the ETF is less likely to take a big hit because it's spread across so many companies. What's even better is that ETFs usually come with low fees, which means more of your money goes toward growing your investment. And if you're wondering how to pick an ETF, most platforms allow you to search for popular ones and compare their past performance.
That's such a solid option, Priya. Now let's talk about dividend stocks. These are stocks from companies that pay out a portion of their profits to shareholders in the form of dividends. Think of it as a reward for investing in their business. Dividend stocks are great because they can provide a steady stream of income, even if the stock price doesn't grow as much. For example, companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble are known for paying consistent dividends. With $100, you could invest in one of these companies or even a dividend-focused ETF, which pools together multiple dividend-paying stocks. Here's a tip. Reinvest your dividends. Most platforms offer an option to automatically reinvest any dividends you earn, which helps your investment grow faster over time.
Absolutely, Ryan. Dividends are like getting a little bonus just for being invested. Now, let's not forget about index funds. These are similar to ETFs, but are often managed slightly differently. They track an index like the S&P 500, and they're known for being low cost and easy to invest in. Index funds are a favorite among long-term investors because they perform consistently over time. If you're just starting, putting your entire $100 into an S&P 500 index fund is a great way to dip your toes into the market. You'll own a piece of the biggest companies in the US without having to pick individual stocks. And here's the best part. You don't need to be an expert or check the market every day. Index funds are set-it-and-forget-it investments. You just let your money grow over time, which is perfect for beginners who want a hands-off approach.
So, to summarize, here's how you might allocate your $100. Put $50 into a diversified ETF like VOO. Use $25 to buy fractional shares of a company you believe in, like Apple or Tesla, and invest the remaining $25 in a dividend stock or index fund to balance growth and income. If you want to keep it simple, you could also put the entire $100 into one solid ETF or index fund. The key is to start small, stay consistent, and learn as you go. Your first $100 investment is all about getting your feet wet and building confidence.
Exactly, Ryan. And one more thing. Don't worry about trying to time the market. Many new investors get caught up in the idea of waiting for the perfect moment. But the truth is, time in the market is more important than timing the market. Starting today, even with just $100, puts you ahead of most people who never take the first step. And remember, you're not locked into your first choice forever. As you learn more and save up more money, you can diversify further and adjust your strategy. But for now, the focus is on taking action and getting comfortable with investing. That $100 could be the start of something much bigger.
Now that we've covered the options available, let's talk about how to put your $100 to work in the smartest way possible. There are different strategies depending on your goals, your risk tolerance, and how much time you're willing to dedicate to managing your investments. One practical strategy is what I like to call the 50-50 split. You allocate $50 to a diversified ETF like the S&P 500, and the other $50 to a fractional share of a single company that you believe has long-term growth potential. For example, if you're bullish on technology, you could invest $50 in a company like Apple or Microsoft, while the other $50 sits in an ETF to balance the risk. This approach lets you have a foot in both worlds, stability and growth. The ETF ensures your money is spread across multiple companies, minimizing risk, while the individual stock gives you the potential for higher returns if the company performs well. It's a great way to start learning about how different types of investments behave.
That's such a practical approach, Ryan. And if you're someone who prefers consistency and doesn't want to worry about picking individual stocks, then dollar cost averaging might be your go-to strategy. Here's how it works. Instead of investing the entire $100 at once, you break it into smaller amounts, say $25 per month, and invest it regularly over 4 months. This method is excellent for beginners because it reduces the risk of investing all your money when the market is high. By spreading your investments over time, you average out the price you pay for your stocks or ETFs. This is especially useful in volatile markets. For example, if you're investing in an S&P 500 ETF, you might notice the price fluctuates week to week. With dollar-cost averaging, you don't have to worry about these ups and downs because you're investing a fixed amount consistently, which smooths out the effects of market volatility.
That's a solid strategy, Priya. And it's not just about risk management. It's about building a habit. Setting up a recurring investment of $25 or $50 every month, even after your initial $100, creates a routine. Over time, this habit leads to a much larger portfolio without you even noticing the small amounts being invested. Another practical strategy, especially for people who want to start small but still aim for growth, is focusing on thematic ETFs. These are ETFs that invest in specific sectors or trends like clean energy, healthcare, or technology. Let's say you're passionate about renewable energy. You could invest your $100 in an ETF that tracks companies in that space. It's a way to align your investments with your interests or values while still diversifying your portfolio. Thematic ETFs tend to be more volatile than broad market ETFs, but they can also offer higher growth potential if the sector performs well. So, it's worth considering if you have a bit more risk tolerance.
That's a great point, Ryan. And speaking of aligning investments with values, some people might prefer starting with robo-advisors. These are automated platforms that help you invest based on your goals and risk tolerance. You just tell them how much you want to invest, like $100, and they take care of everything, from selecting investments to rebalancing your portfolio. Platforms like Betterment or Wealthfront are popular for this. They're perfect for beginners who want to invest without diving too deeply into research. And most robo-advisors offer fractional shares, so your $100 gets fully invested across a diversified portfolio. Another idea for the risk-averse investor is focusing entirely on dividend-paying ETFs or stocks. Imagine investing $100 in a dividend ETF where your returns include not just the stock price appreciation, but also quarterly dividend payments. Over time, those dividends can be reinvested, helping your portfolio grow even faster.
All of these are fantastic strategies, Priya. But I want to stress something. No matter which strategy you choose, the most important thing is to start. It's easy to get caught up in analysis paralysis, trying to pick the perfect stock or the ideal moment to invest. But the truth is, taking action is what sets you apart from those who never start. A good approach is to pick one of these strategies, whether it's the 50-50 split, dollar-cost averaging, or going all in on a diversified ETF, and stick to it. Track your progress, learn as you go, and don't worry about making mistakes. The stock market is a long game, and small, consistent steps can lead to big results over time.
Exactly, Ryan. Investing with $100 is as much about building confidence as it is about making money. Start small, experiment with strategies, and keep learning. Remember, you're not just investing in stocks. You're investing in yourself and your financial future. And don't forget, platforms today make it incredibly easy to adjust your strategy as you learn more. If you start with an ETF and decide later to add individual stocks or dividend investments, you can. Your $100 investment is just the beginning of a much larger journey. So, choose a strategy that feels right for you. Take that first step and trust the process. The most important thing is to get started.
Now that you've invested your $100, let's talk about the next step, monitoring and managing your investment. Many beginners think that once they've made an investment, their work is done, but that's only part of the story. Keeping track of your investments is crucial to ensure you're on the right track toward your financial goals. Start by regularly checking your portfolio, but here's the catch: don't overdo it. It's tempting to check your account every day, especially if the stock market is volatile. But this can lead to emotional decisions like panic selling when prices drop. Instead, set a routine to review your investments, say once a month or even quarterly. You can use tools like Google Finance or Yahoo Finance to track the performance of your stocks or ETFs. Many brokerage apps also have built-in tracking features that show your portfolio's performance at a glance. Pay attention to metrics like percentage growth, dividends received, and the overall trend of your investments.
Exactly, Ryan. And while monitoring is important, you also want to make sure you're not reacting emotionally to short-term changes. One way to do this is to focus on the long-term goals of your investment. Remember, the stock market has ups and downs, but historically, it has always trended upward over time. Another key part of managing your investment is rebalancing. As your portfolio grows, you might find that some investments outperform others, which could shift your asset allocation. For instance, if you initially put $50 into an ETF and $50 into a stock, and the stock grows faster, it could make up a larger percentage of your portfolio than you planned. To rebalance, you might decide to invest more in the ETF to bring your allocation back in line with your original strategy. Most brokerages make this process easy, and some even offer automatic rebalancing for ETFs or robo-advisors.
Great point, Priya. Another thing to keep an eye on is the performance of the specific companies or funds you've invested in. If you bought a fractional share of a company, keep up with their quarterly earnings reports. These reports give you insights into the company's health and future prospects. For example, if you invested in a technology stock and their earnings report shows strong revenue growth and innovation, that's a good sign to hold or even invest more. On the flip side, if the company reports losses and doesn't show a clear plan to recover, it might be worth considering reallocating your funds to a more stable option. With ETFs, it's a bit easier since they're inherently diversified. However, you should still review the ETF's holdings periodically to ensure it aligns with your investment goals. If you're investing in a thematic ETF, check if the sector is performing well overall.
One last piece of advice. Use automation wherever you can. Most brokerages allow you to set up automatic reinvestment for dividends, which means any earnings you receive are immediately reinvested to buy more shares. This is a simple but effective way to grow your portfolio over time without having to lift a finger. Another option is setting up recurring investments. For example, after your initial $100, you can automate an additional $25 or $50 every month. This not only builds consistency, but also helps you take advantage of dollar cost averaging without even thinking about it. Managing your investment doesn't have to be time-consuming or stressful. With the right tools and habits in place, you can stay on top of your portfolio while keeping a long-term perspective. And remember, the goal is progress, not perfection.
That's exactly right, Priya. Monitoring and managing your investment is about finding the balance between staying informed and staying patient. You've already taken a big step by investing your $100. Now it's all about nurturing that investment over time. Keep learning, keep refining your strategy, and remember that building wealth is a marathon, not a sprint. With consistent effort and smart management, that $100 could grow into something truly impactful. All right, now that we've talked about building and managing your investment, let's dive into something equally important: avoiding common mistakes. When you're starting with $100, every decision matters, and steering clear of these pitfalls can make a huge difference. The first mistake I often see is impulse buying or selling. Many beginners panic when they see the market dip or get overly excited when a stock is trending upwards. For example, if you invest $50 in an ETF and it drops by 5%, it might feel like a big loss. But here's the thing: short-term market fluctuations are completely normal. Selling during a dip locks in your losses, while holding gives your investment a chance to recover. The same applies to hype-driven purchases. Let's say you hear everyone talking about a hot stock on social media. Jumping in without researching the company or understanding its fundamentals is risky. Remember, your $100 is valuable. Don't let FOMO, or fear of missing out, drive your decisions.
Absolutely, Ryan. Emotional decisions are one of the biggest hurdles for new investors. Another common mistake is ignoring fees. Even though most platforms now offer zero commission trading, there are still other costs to be aware of, like expense ratios for ETFs or withdrawal fees. For instance, if you invest $100 in an ETF with a high expense ratio, say 1%, that might not seem like much, but over time, those fees add up and eat into your returns. Always check the fine print and aim for investments with low fees, especially when you're starting with a small amount. Another mistake I've seen is lack of diversification. Putting all $100 into a single stock or sector might seem exciting, especially if that stock performs well initially, but it's risky. Imagine you invest everything into a trending tech company, and a few months later, they face a major setback. Without diversification, your entire portfolio takes a hit. A simple solution is to start with an ETF or spread your money across 2 or 3 investments.
Great points, Priya. Let me add another one: not reinvesting dividends. If you're investing in dividend-paying stocks or ETFs, reinvesting those dividends is one of the simplest ways to grow your portfolio. Many platforms offer automatic reinvestment, so take advantage of that feature. Here's another mistake to watch out for: chasing quick profits. Some beginners treat the stock market like a get-rich-quick scheme, but that's a recipe for disappointment. Investing is a long-term game. If you're constantly jumping in and out of trades to chase gains, you'll rack up fees, lose out on compounding, and possibly make poor decisions in the heat of the moment.
That's so true, Ryan. And while we're on the topic of mindset, here's another big mistake: not having a plan. Investing without clear goals can leave you feeling lost. Are you investing for retirement, to build wealth, or simply to learn? Your goals will guide your decisions. For example, if your goal is long-term wealth building, you'll likely focus on diversified ETFs and dollar-cost averaging. On the other hand, if your goal is to learn, you might experiment with fractional shares of different companies to understand how the market works. Finally, one of the most common mistakes I see is giving up too soon. The stock market can be intimidating, especially if your first few investments don't perform as expected. But remember, even the most successful investors started small and learned through trial and error. Stick with it, keep learning, and trust the process.
Exactly, Priya. Mistakes are part of the journey, and the key is to learn from them rather than let them discourage you. To recap: 1. Avoid emotional decisions like panic selling or buying into hype. 2. Watch out for fees and choose low-cost options. 3. Diversify your investments to minimize risk. 4. Reinvest your dividends to maximize growth. 5. Stick to your plan and play the long game. With these tips in mind, you'll be well on your way to building a strong foundation for your financial future. Now that you've made your first $100 investment, let's talk about scaling up and building a sustainable investing habit. The key to growing your portfolio isn't just about picking the right stocks or ETFs, it's about consistency. One of the best ways to expand beyond $100 is by setting up automated contributions. Let's say you decide to invest $25 every month after your initial $100. Over the course of a year, that's $300 in additional contributions. Combine that with the power of compounding, and you'll see your portfolio start to grow exponentially. Automation takes the guesswork out of investing. Most platforms allow you to set up recurring deposits from your bank account, so your investments happen on autopilot. This is especially helpful for busy professionals who want to stay consistent without spending too much time managing their accounts.
Exactly, Ryan. Automation is a game changer. But beyond that, it's also about creating the right mindset. One effective strategy is to treat investing like a bill you have to pay every month. For example, just as you budget for rent or groceries, set aside a portion of your income for investments. Even if it's just $50 or $100 each month, the habit is what matters. As your income grows, you can increase your contributions. For instance, if you get a raise or a bonus, allocate a percentage of that toward your portfolio. This ensures you're not just spending more as you earn more, you're also building wealth faster. Another tip is to continue diversifying as your portfolio grows. After starting with ETFs and fractional shares, you might consider branching out into different asset classes like bonds or REITs, real estate investment trusts. These can help balance your portfolio and reduce risk as you scale up.
That's a great point, Priya. And let's not forget the importance of staying informed. As you expand beyond $100, take time to learn about new opportunities, Whether it's reading books, following financial news, or listening to podcasts like this one, it's also a good idea to set milestones for your portfolio. For example, aim to grow your $100 investment into $1,000, then $10,000, and beyond. Celebrate these milestones. They'll keep you motivated to stay on track.
Exactly, Ryan. Expanding beyond $100 is all about creating a system that works for you. Automate your contributions, diversify as you grow, and stay committed to learning. Your journey might start small, but with time, patience, and consistency, you'll see your efforts pay off. And remember, the first $100 is just the beginning. By building sustainable habits, you're setting yourself up for long-term financial success. Taking the first step with $100 is powerful, but consistency is what builds wealth over time. Start small, stay consistent, and watch your investments grow.